Get right into it. Today, we're not just looking at the headlines for India's banking giants. No, we're going to tear down their latest earnings reports just like a hedge fund manager would, hunting for those little signals the rest of the market might be missing. We're talking growth champions, hidden risks, and ultimately, where the really smart money is going to flow. Let's do this. So, this is the big question, right? When you cut through all the noise, which of these banks is giving you the best bang for your buck, the best risk-adjusted return over the next year? To figure that out, we've got to meet our three main players. First up, we've got Axis Bank. Now, as India's third largest private bank, it's a real heavyweight, always in the conversation. But, it often gives investors a more complex picture to figure out. Let's see how it's looking. Next, the absolute titan of the industry, HDFC Bank. For years, this was the gold standard, right? The benchmark everyone else was trying to beat, known for its incredible consistency. But the question is this giant still as nimble as it used to be? And rounding out our trio, we have ICICI Bank. It was the underdog for a while, but it has staged this massive, impressive turnaround and is now coming out swinging, aggressively going for that top spot. So you've got three banks, three totally different stories. How in the world do we pick a winner? Well, we're going to use a simple but really powerful four-step approach. We'll kick things off with top-line growth. Then we'll see if that growth is actually making any money. After that, we go hunting for any hidden risks. And then finally, we'll deliver the verdict. So let's get started. First things first, the growth race. Look, in a market like India, you're either growing or you're dying. You have to capture market share. It is everything. So let's see who's really putting the pedal to the metal. Okay, so the data here tells a few different stories right off the bat. ICICI, they're the clear leader in just pure across-the-board loan growth. HDFC is doing what HDFC does, chugging along at a steady, predictable pace. But look at Axis. They are strategically crushing it in the high-growth SME market. That's small and medium enterprises with an unbelievable 33% jump. That is a very specific, very aggressive bet. Let's just pause on this number for a second. Almost 16%. In this economy, that's not just growth, my friends. That is a loud and clear statement. It tells you ICICI is on offense, and they are actively stealing market share from their rivals. So on growth, the takeaway is simple. If your bet is on pure, unadulterated expansion, ICICI is your horse. But as any smart investor knows, growth is only half the story. The real question is it profitable growth? Growing super fast can sometimes just mean you're burning through cash. So now we check the bottom line. We're going to look at two key things: profit after tax, which is basically the final score, and the super important net interest margin, or NIM. That tells you how much money the bank is actually making from its main job, lending money. And this is where the plot thickens. On pure profit growth, HDFC is leading the pack. ICICI is right on its heels. But wait a second. Look at Axis Bank. Its profit actually went down this quarter. Now, on the surface, that looks pretty bad. But then you look at the margins and the story completely flips on its head. This chart makes it crystal clear. Axis Bank is squeezing more profit out of every single loan it makes than HDFC is. So even though its total profit number was down, its underlying business, its core lending engine, is actually the most efficient one here. That is a classic signal that analysts look for. So the takeaway here is a bit more nuanced, right? Axis is winning on the quality of its earnings with those better margins, but HDFC delivered the bigger profit number. This kind of suggests Axis might be under-earning its potential, which is a classic hedge fund observation. Okay, now for the most important question of all. What about the risks? This is it. This is where a great analyst really earns their keep. High growth and fat margins mean absolutely nothing if your loan book is a ticking time bomb of bad debt. So let's take a hard look at asset quality. Okay, pay attention because this slide is where the real risk analysis starts. ICICI and Axis both have incredibly low net NPAs. That's bad loans they haven't yet set money aside for. But HDFC reports something different: Stage 3 loans. Now, you can think of Stage 3 as a much wider bucket of all loans that are under significant stress, not just the ones that have officially defaulted. And while the definitions are different, a number like 2.44%, well, that's a potential yellow flag. It suggests a much larger pool of at-risk loans we need to dig into. So let's be super clear about what this means. ICICI's number suggests its loan book is rock solid, super clean.
In contrast, HDFC's much higher stage 3 number, even though it's a different metric, it hints at a bigger reservoir of potential problems down the line. For an investor, this is what we call a hidden risk. It's a big question mark on the balance sheet that isn't obvious at first glance.
So the verdict on risk? It's not even close. ICICI Bank is the hands-down winner on asset quality. They've somehow managed to grow like crazy without messing up the quality of their loan book. And that, my friends, is the absolute holy grail of banking. All right, we've crunched the numbers on growth, we've checked the profitability, and we've sniffed out the risk. Now it's time to put it all together and deliver the final verdict, just like we would in a Monday morning portfolio meeting. And here it is, our final scorecard. ICICI Bank takes the trophy for growth and asset quality. Axis Bank gets the crown for margins. But the most important category, the one that every serious investor cares about most, is risk-adjusted returns. And on that one, with its best-in-class combo of high growth and low risk, ICICI Bank is the clear standout winner. So, if we had to rank them for the next year, it would look like this. For generating alpha, that's just fancy talk for outperforming the market, ICICI's growth and quality 1-2 punch puts it at number 1. And for downside protection, well, its super low bad loans, again, put it right at the top, giving you a much bigger margin of safety. To boil it all down, here's our one-line thesis for each of them. ICICI Bank, it's the growth champion with a squeaky clean balance sheet. Axis Bank, it's the margin leader, but it's got to figure out its profit growth problem. And HDFC Bank, it's still the steady giant, but investors need to keep a very, very close eye on that asset quality number. And that kind of leaves us with one last thought to chew on. In a market as dynamic as India, is pure aggressive growth going to win? Will superior margins and efficiency be the deciding factor? Or, as our analysis seems to suggest, will the ultimate champion be the one that can masterfully balance both explosive growth